We're going to check in on the bond market now, as we do this time each week. We're joined by Jim Stening from FIIG Securities. Jim, thanks as always for coming in.
Thanks, Carl.
Let's start off with the Commonwealth Government inflation-linked bonds, known as linkers.
Yes.
A tender came out yesterday. How was that received?
Well, it was a really good result. When they announced the tender, they were talking about issuing $1 billion worth of these securities, a September 2025 index-linked bond. And the result was a total of $5.5 billion worth of bids.
Wow.
So
Yeah.
it was fairly impressive. And the bid also included an opportunity to switch out of existing linkers into the new one. Bids, I think, for that side of the transaction totaled $1 billion. They ended up issuing $4 billion, so even including the switch volume, it was oversubscribed and needed to be scaled back.
So where's the demand coming from? Why are traders wanting them?
Well, I think that this is a very efficient way for fund managers and individuals and any investor to hedge against inflation over the longer term. They haven't been issued for a long time by the Commonwealth Government. We've seen some state government issuance, but realistically, these assets are attractive to fund managers and a range of international investors.
And what about on the corporate side? I mean, would they issue these kinds of bonds? What's the...
Well, the interesting thing, I mean, if you put yourself in the position of an issuer, say the Commonwealth Government, I mean, the Commonwealth Government's in a good position because a lot of their receipts, or some of their receipts, are indexed to inflation. So I suppose from a corporate issuer's perspective, they need to be satisfied that they're not exposed to rampant inflation, because obviously the cost of their funds could rise dramatically, and they may not have the opposite side to offset that.
So what does the tender yesterday, and I suppose the interest in the tender, say about what the market thinks about inflation going forward?
Well, yeah, it's really interesting. I suppose, you know, if you compare the nominal yield or the normal fixed rate yield to the yield that these assets were bought at, it implies a break-even inflation of around 2.5%. So, if you look at the Reserve Bank's band, it's right in the middle there. But I think overall, there's certainly demand for these assets to insure against inflation moving higher as we move through the cycle.
Okay, let's move on. I want to talk about the tax office treatment. CBA has issued that we've got pearls versus the hybrids. What's been the problem? Because the ATO has sort of come back to the CBA and it's got a few issues with
That's
some
right.
of
I mean, there's a question mark at the moment over the whether or not the CBA can provide investors with franking credits as a distribution on the pearls. So yeah, that's the crux of the matter, I suppose. Basically, you know, the CBA have come out and said that they will be providing frank returns, or subject to the outcome of the discussions with the ATO. The options are for them, I suppose, to gross up the returns. The interesting thing about franking, you know, franking, everyone seems to get excited about franking, but essentially, if you're receiving a grossed up return along the way, rather than you know, cashing in your franking credits over a 12-month period, you know, it's effectively a better way to receive income.
Okay, because I mean that's a strategy that a lot of people use. So you're saying
they do. It's very interesting. I mean, you know, we recently released a paper on this. You know, I think that if you like, the benefits of franking are well and truly arbitraged out of the market. So it seems to me that it's not you know, it's not as relevant as it perhaps may have been in the past.
Okay, we had some interesting data, I suppose, commentary come out from the federal government earlier in the week, looking at where the federal budget is now compared to, of course, you know, everyone was thinking that the deficit was going to be, you know, a crazy amount. It's come out, things seem to have tempered, I suppose, was around the commentary that was coming out from the Treasurer. What did you sort of take from that statement in terms of where the government sees the economy sitting at the moment?
Well, I guess, I mean, it's a good result. It's a lower deficit than what was expected, and I think to a certain extent it's been managed very well. Our expectations have been managed very well. You know, they've understated and over-delivered. So, but on the reality is it's still a very large deficit, and I suppose you know, this whole cycle hasn't played out yet. We may have surprises the other way going forward. The reality is there's still a lot of bonds to be issued to fund the deficit going forward.
So will it affect the government's borrowing program?
Well, I think, you know, arguably it could mean that they have to issue fewer bonds. But also it may mean that monetary policy may be tightened sooner rather than later, given that the economy's you know, moving in the right direction. So obviously that means increases in cost of funds. So
soon next week. Tuesday?
Well, look, I don't think so. I mean, I think that we've got some very important statistics that are coming out at the end of this month, the quarterly inflation data, and I think that that's something that the Reserve Bank would be very interested in, obviously. I mean, inflation's the key in terms of when we start pulling the levers, as Paul Keating used to say. So, yeah, I think it's prudent to wait for that data.
Okay, so are you in the probably November camp, depending on what we see data-wise at the end of October? God, it's October already.
Yeah, look, I am. Yeah, I think so. I think if there's a hint of, I mean, bearing in mind that these sort of core inflation numbers that the Reserve Bank look at are sort of remaining stubbornly high, whereas the headline inflation's falling away, it is a sort of a pivotal statistic.
Okay, I want to go on to another topic, wholesale funding. I mean, talk about it nearly every week, but we had the Commonwealth Bank this week lift some of its fixed loan rates. Ralph Norris saying, look, you know, a lot of the funding that we had locked in has now sort of rolled off, so we're having to redo a lot of that funding, and of course that funding was locked in before the financial crisis. Things have changed, the rates are going to be higher, things haven't stabilised, the cost of funding is still high. Is that what you're seeing?
Yeah, look, we are, yeah. I mean, there's been a lot of talk about, you know, where the interbank where banks will lend to each other and how those margins had blown out through the crisis and how they've returned to pre-crisis levels. But I think what people are forgetting is that they've returned to pre-crisis levels with a government guarantee. I mean, people are very comfortable with that. What we're seeing in the short-term money markets is extreme competition, you know, sustained competition for deposits. And we're in a situation now where these rates are really pushing higher. There's a lot of competition in the market, you know, all along the curve, so from 30 days out to 2 years, 5 years, and that really is pushing up the cost of funds for all of the banks. So particularly the majors. I mean, they're in there borrowing very heavily. So
if/when the deposit guarantee comes off, what's that going to mean for, you know, the man in the street, the borrower? What are we going to see in terms of rates? Well, regardless of what the RBA does.
Yeah, well, one would hope that they don't remove the government guarantee until things stabilise. I suppose the man in the street, in terms of investors' perspective, competition for short-term deposits is a great thing. But I think what this is having the effect of doing is probably pushing up, you know, the borrowing rates in the housing sector, potentially over and above any official tightening.
But just quickly, so if they did keep this deposit guarantee in for a lot longer, I mean, there are a lot of other smaller institutions who are saying get rid of it because it makes the playing field unlevel.
Yeah, look, I think, you know, what you're referring to there is more a wholesale issuance proposition, but effectively this is really the deposit guarantee for deposits up to $1 million.
All right, we're going to have to leave it there, unfortunately.
Okay, thanks, Kylie.
Thank you very much for coming in.